deferred income tax accounting. This is a very important topic for in the pandemic situation. We are experiencing COVID-19 situation for the last 2 years. From the accounting perspective, approximately from last first quarter of the last year to this quarter, around 6 quarters, we are facing problems in issues related to sales, profit, etc. This is subject. Deferred income tax accounting is related to a company which makes profit, company which incurs losses, how the deferred income taxes are shown as an asset in the balance sheet, deferred income tax liability is shown as a liability side, how it affects the company's performance during this pandemic period. This is my topic, which is related to it's a blend of accounting and the income tax subject. My aim of this presentation is I cover in 1 hour 15 minutes why there is a difference between taxable income and pre-tax accounting income. This first question. Why deferred tax asset and deferred tax liability arise in financial statement? This is a very important component in the asset side, means current assets and current liabilities. Why this arise and how it continues in the balance sheet, how it should be set off against the current tax liability. And the third question is, which are the requirements of Ind AS 12 income taxes? This is a new standard introduced in India from 2017. How accounting for income taxes have been practiced by companies. We look into some of the annual report of the companies to see how this has been practiced by companies. This is the aim of my presentation. If you look into the accounting is an information system which starts with the input, business transactions. We process the business transactions using journal entries, ledger, trial balance, profit and loss account, balance sheet, etc. We get the output in the financial statements in the form of profit and loss account, balance sheet, etc. And this is meant for users. Users of accounting mainly consists of owners, shareholders, creditors, prospective investors, lenders, etc. They are the users. Accounting is meant for providing information to meet the information needs of users. The users will use this information to make a decision whether to lend the money, whether to invest in the equity shares or debt instruments. This is the background of accounting. And this is the cycle. I'm not going to discuss this. Accounting cycle start with input, processing the transactions, and we get output in the form of financial statements. We record the business transactions using manual system or accounting softwares, and we prepare the output, trial balance, profit and loss account, etc. I focus on two legislations directly related to the accounting. When preparing financial statements, while filing the income tax returns to the income tax department, we must follow the two acts. One is Companies Act 2013 amended till date and Income Tax Act amended till date. These are the two acts under which we prepare the profit and loss account and balance sheet. There is no compatibility between these two acts. What Companies Act says may not be equal to or same to that of Income Tax Act. There's often we see the conflict in Companies Act and Income Tax Act provisions. This conflict will result in deferred tax asset and deferred tax liability because of the timing differences of recognition of income, measurement of income, and also disclosure aspects. If we focus on Income Tax Act and rules, we are all familiar with the Income Tax Act, especially section 32 deals with the depreciation and so many income tax under the head business and profession. There are several sections are there. Income Tax Act and its rules are complied with while filing the income tax returns on the basis of financial statements. Often there is a conflict between income tax provisions and Companies Act related to recognition, measurement, and disclosure of financial information. While preparing income tax returns on the basis of annual financial statements or quarterly financial statements, we focus on three aspects. One is current year's tax liability. What is the current year's tax liability? We ascertain as per the provisions of Income Tax Act. And also we look into two aspects. One is a deferred tax liability and deferred tax asset. This deferred tax liability and deferred tax asset arises from out of the accounting provisions, whereas the current year's tax liability arises on account of income tax provisions. We have to correlate these three items while ascertaining the tax liability. We focus on determining taxable income. Taxable income is determined under the Income Tax Act by following the provisions of the Income Tax Act under the heads of income. This taxable income, while computing in the Income Tax Act, determines what is the current tax liability of a company, of an assessee. This tax liability consists of two portions. One is current tax portion, second one is deferred tax portion. All of you are familiar with the current tax portion. Current tax portion is the current tax liability for that year. Deferred tax portion is the sum of deferred tax liability and deferred tax asset carried forward in the previous year as per the accounting provisions. We have to adjust the current tax liability against the deferred tax asset and deferred tax liabilities. Finally, we'll find out the how much amount the company should pay the tax to the government. If you go to the accounting, we have a profit before tax, PBT. We deduct tax, therefore we get a PAT, profit after tax. While calculating profit before tax under the accounting, we follow the accounting provisions, accounting rules and regulations, accounting standards. While calculating income tax amount to be deducted from the profit, we follow the provisions of Income Tax Act. Therefore, we call a term pre-tax accounting income. Pre-tax accounting income means income determined before deduction of the tax is computed as per the provisions of financial reporting rules and regulations. This income tax amount is deducted from the pre-tax accounting income to determine the profit after tax. Often we see the difference between taxable income and pre-tax accounting income. They are not same. Taxable income is computed for tax reporting. Accounting income is computed for financial reporting. This difference arises due to differences in the provisions of Income Tax Act and also the provisions of Companies Act, accounting standards, SEBI regulations, RBI regulations. So many rules and regulations framed by regulatory agencies will influence the accounting income, whereas Income Tax Act only influence to determine the taxable income. So there is a difference exists between taxable income and accounting income. Why the difference arises? Why the taxable income is not equal to accounting income? We call it as a timing differences. Recognition of a expense or income or measurement of income or expense, there's a difference. This is called timing differences. Profit determined for tax purpose is different from profit shown in the profit and loss account. This difference arises in one accounting period and reverse in other accounting period. I can give you some examples how this timing differences arises and how it reverses in the subsequent accounting periods. So overall, if you look into the overall picture for a period of 10 years, what is the impact on accounting profit and also taxable income? Types of timing differences. Conceptually, there are two types of timing differences. One is permanent differences, another one is temporary differences. Which are all the permanent differences? The permanent differences means a revenue or a gain, expense or a loss enters the computation of taxable income or pre-tax accounting income, but not in the both. Means, suppose I can give an example. Tax-free interest income will not come in the taxable income determination, whereas it will come in the determination of accounting income. Some of these examples are tax-free interest income. Interest is tax-free on most government securities for taxable purpose. Therefore, it is not included in the taxable income. While it is an income, therefore, we are adding to the credit side of the profit and loss account. Till last year, dividend was not taxable in the hands of shareholders. It was free, but now it is taxable. Fines and penalties. Suppose if you violate the income tax rules and regulations, income tax department will fine and imposes the penalty on the assessees. And these fines and penalties are not deductible for calculating income tax, taxable income, while they are deductible for calculating accounting income. So therefore, there's a difference between taxable income and accounting income. And there are disallowed expenses. Some expenses are disallowed while computing taxable income. I think you know the business end. There are clearly is given which are all the allowed expenses and disallowed expenses. Suppose one example is goodwill written off. We show it in the profit and loss account, but it cannot be taken into calculating the taxable income. Therefore, there is a difference between taxable income and accounting income. They are permanent in nature. Permanent means we cannot reconcile. This will exist permanently. These differences will not be reconciled between the accounting income and taxable income. On the other hand, there are some temporary differences. Temporary differences arises when the measurement rules of financial reporting as per the Companies Act or Ind AS requirements differs from the taxable under the provisions of Income Tax Act. This we call it as a timing differences on temporary basis. This will arise the recognition of revenue, gains, expenses or losses, or assets and liabilities. This temporary difference affect the computation of taxable income or pre-tax accounting income in one period, in one accounting period, but in subsequent accounting period, it reverses. Means totally 2 years or 3 years or 4 years, it will reverses. End result will be nil. These temporary differences are temporal in nature. They are not permanent in nature. This will originate in one accounting period and reverse in another accounting period. I give some example here. Depreciation amount is one example of temporary differences. Income Tax Act 32 says that WDV method should be followed for determining income tax amount, and also section 32 gives the rate of depreciation. It may be 100% for some assets, 30%, 25% like this. Different rates are given in the section 32. Whereas in accounting, the rate of depreciation is not given by the Companies Act, but it says that you must calculate the rate of depreciation on the basis of the residual value, on the basis of the life of the asset, original cost, using straight line method or WDU method. Larger amount of depreciation is deducted for tax purpose in the early years of an asset's life if you follow the WDU method. While if you follow the straight line method, you have to give the depreciation evenly for throughout the life of the asset. Therefore, depreciation amount given for determining taxable income or determining accounting income varies because of the method followed is different, WDU method or straight line method or some other method. I take an example here. Original cost of an asset is 10,000 rupees. Life of the asset is 10 years. Residual value is 100. The question is, what is the amount of depreciation under WDV method and straight line method? I think all of you are familiar with the formula. The rate of depreciation is not given. Depreciation is calculated under straight line method using the formulas original cost minus residual value divided by number of years. It means 10,000 minus 100 rupees, 9,900 divided by 10 years. You have to give depreciation 990. Rate of depreciation comes to 9.9% under straight line method. This is the formula we use. So suppose if you calculate the depreciation amount using the straight line method, year 1, 2, 3, 10 years, depreciation cost minus depreciation, you get residual value 100 at the end of the row. Depreciation amount is same throughout the life of the asset. Total depreciation is 9,990. This is the calculation under straight line method. How this will impact on the taxable income and accounting income, we'll discuss later. Yes. Any questions? Shall I continue? If you follow the written down value method, if the rate of depreciation is not given, then we have to calculate using the formula. WDU formula is rate of depreciation is equal to 1 minus nth root of residual value divided by cost. 1 minus 10th root of means 10th is the 10 years, number of years. 10th root of 0.01. Residual value is 100 divided by cost is 10,000. You get decimals of 0.01. 10th root of 0.01 is equal to 0.630957. So rate of depreciation under WDU method is 36.9%. Look into the rate of depreciation. The straight line method, it is 9.9%. Under WDU method is 36.9%. Huge gap in the rate of depreciation. If you provide the depreciation under WDU method, you give more depreciation amount in the beginning of the asset life, whereas at the end you give less depreciation. Whereas in straight line method, you are giving the same amount throughout the life of the asset. Since the method is different, the rate of depreciation is different, and amount of depreciation is different, it results in the taxable income and pre-tax accounting income. This table gives you the WDV in the second column, first column, the life of the asset, third column, depreciation amount. If you provide the depreciation under the 1 year 3,690 to 2,322.29 like this, you get a 9,990 total amount of depreciation. Residual value is 100 rupees. The amount of depreciation under WDV method is going on decreasing. At the end, you are giving only 58 rupees, whereas in the straight line method, you have given 9,900 rupees as a depreciation. Depreciation expense, you are deducting from the taxable income. As per the Income Tax Act, you are deducting more depreciation in the beginning of the asset life, less in the end of the life. Therefore, there's a difference in the taxable income. Same is as in the case of accounting income. We propose hypothesis. Hypothesis 1. Total amount of depreciation provided in WDV method and straight line method is same, 9,900. If you look into this table, 9,990 is the total amount of depreciation as per WDV method, and as per the straight line method also, 9,990. So our hypothesis 1 is amount of depreciation provided on the asset throughout the life of the asset is same, 900. Whereas there's a difference in the amount of depreciation. Please switch off your. Okay, shall I continue? Second hypothesis, hypothesis 2, there is a difference in the amount of depreciation provided in each accounting year. There are two methods. Look into the table. The depreciation amount is different for each year. Okay. Therefore, our hypothesis is total amount of depreciation remains same throughout the life of the asset, whereas the amount of depreciation given in each accounting year varies from year to year. These are the two hypotheses. Third hypothesis is WDV method provides more depreciation during the first 3 years, around 7,488. We have totaled it 3,690 plus 2,329 plus 1,469, while it provides less depreciation during the next 7 years, 2,412. Hypothesis 4 is straight line method provides equal amount of depreciation here, which is equal to 990. These are the 4 hypotheses we have formulated. Example we have given. We have understood what is the difference between accounting income and taxable income, temporary differences and permanent differences. We concluded that permanent differences will not affect, whereas temporary differences will affect the taxable income or accounting income. With these two examples, what is the implication of this on the, look at the implication here. This table is derived from the earlier two tables. Depreciation under WDV method, we have given here 9,900 total amount. Depreciation under SLM method, we have given 990, total is 9,900. If you find the difference for each year, you see 2,700 is the difference, 1,339 and minus and plus, finally 0. Means, what is the 0? Why 0 has come means the difference in the depreciation under WDV method and straight line method for all the years is 0. Means total amount of depreciation is given under two methods is same, while in each year it differs. It may be plus or minus. Now we discuss the implications here. Larger amount of depreciation is deducted for tax purpose in the early years of asset life, while lower amount of depreciation is deducted in the later years under WDV method for tax purpose. Whereas in accounting, higher depreciation amount deducted under IT Act during first 3 years of life, 4,518, is reversed by deducting lower amount of depreciation during the next 7 years. If you find the total here, in the second column total if you find, or in the last column if you add plus and minus, 4,518 is the more amount charged in first 3 years. This amount is reversed in next 7 years. This is the total of the first 3 rows in the third column, total of the next 7 rows in the last column. Therefore, 0 comes here. Means sum of the differences for 10 years is 0. Sum of the differences in amount of depreciation on the straight line method and WDV is 0. Okay, this is 0. Whereas there exists a difference in each year. This difference would impact on deferred tax asset and deferred tax liabilities. You try to understand this point. The difference in the amount of deferred tax asset and deferred tax liability is related to the we continue to discuss some of other examples. These are some examples are there. Prepaid expenses, for example, in accounting, we follow accrual system of accounting in accounting, prepaid rent, insurance, and similar items which are reported as assets and expensed over the period of usage for financial reporting. Whereas Income Tax Act follows cash system of accounting. They are deducted for tax purpose as and when they are paid. They are not deferred to the next accounting period because it has been paid. Therefore, you are charging to the income tax purpose. So another difference is accrual system of accounting and cash system of accounting. You take one example, prepaid expenses. It has two portions, current portion, which is expense, and deferred portion, which is asset. We are showing it as an asset in the balance sheet. Prepaid expenses, another example I'm giving here. Prepaid rent rupees on 1/3/20 is 7,000. Rent per month is 1,000. 6 months rent from April 20 to June 20 is paid in advance. Under financial accounting, 1,000 is shown as expense for financial year 1920, 6,000 is shown as an asset for the next year. Whereas in income tax purpose, entire amount is shown as expense under the tax purpose without classifying as a prepaid rent or the amount paid for this year or next year. Similarly, we have examples called income received in advance. Rent received in advance is reported as liability under later it is shown as income under the accrual basis of accounting. Whereas tax purpose under the accounting, it is shown as income received even though in advance. What is the impact of temporary differences? Temporary differences originate in one accounting period and are sometimes referred to as originating differences, and later on they are reversed in future accounting period. And we also call it as a reversing differences at later year. The sum is always zero. What is the impact of these temporary differences? We have two concepts here. One is future taxable amount and future taxable liability. Future taxable amounts are temporary differences that increase taxable income related to pre-tax accounting income in future periods when reversal occurs. First one is future taxable amounts. Second one is future deductible amounts. Deductible amounts means future temporary differences that decrease taxable income related to pre-tax accounting income in future periods when reversal occurs. This is a table which gives you examples of future taxable and deductible amounts. In the first column, sources, common sources. Second column, example. What is the impact in the third column? Look into the second row. Revenues are included in the pre-tax accounting income but not in taxable income. Example, interest income accrued but not received. As per accounting, interest income accrued, we consider them as income, but Income Tax Act, it has not been received, therefore it is not considered. We also call it as outstanding incomes. This results in deferred tax liability, means future taxable amount. Any future taxable amount results in deferred tax liability. Revenues are included in the taxable income, but not in the pre-tax accounting income. For example, income received in advance, that results in deferred tax asset. Future deductible amounts. What is the rationale for this difference? We are following cash system of accounting and accrual system of accounting. Another table gives you expenses. Expenses are deducted from taxable income, but not in pre-tax accounting income. For example, in expenses paid in advance, we call it as a prepaid expense. That results in deferred tax liability. Expenses are deducted from pre-tax accounting income, but not in taxable income. We call it as outstanding expenses. That results in deferred tax asset. Again, the reason is cash basis of accounting and accrual basis of accounting. So this, we have understood this, some examples, what is the conceptual basis for this? Underlying accounting theory behind this is, we have to find out whether it is beneficial to the company or company has got some obligation to pay the tax. So for deferred income taxes, the measurement of the future income tax effect, it may be benefit or obligation that arise from the current temporary differences. Today we have current differences. What is the impact on the future accounting period? That results in deferred tax assets and liabilities. We have a method recommended by the Ind AS, Indian Accounting Standard. This method is called asset liability method. The asset liability method is used to account for temporary differences. Under this asset and liability method, we calculate deferred tax assets and deferred tax liabilities at the end of each accounting period, and we show it in the balance sheet in every accounting period. We try to understand what is deferred tax liability. Future taxable amounts, we have given some examples in the earlier slides, result in future tax obligations because they cause an increase in future taxable income relative to pre-tax accounting income. Therefore, they are called deferred tax liability. On the other hand, deferred tax asset, future deductible amounts result in reduced future tax obligations, means your tax liability in the future period is reduced because of deferred tax asset. They are called deferred tax asset. The deferred tax asset or liability measures or estimates of the future tax cash flows, consequence of existing temporary differences. We are estimating for the next accounting periods because of the temporary differences in the current period. So now I come back to my first, I had given some the aim of my presentation. As a tax student or accounting student, we are concerned with what is the current portion of the income tax liability of a company. Current portion of the income tax expense for any period is computed on the basis of heads of income under the Income Tax Act and applicable provisions. Tax payable or tax refundable for the year is the current portion of the income tax expense or savings. What is the deferred portion of income tax? The changes in the balances of deferred tax asset and liabilities for every accounting period at the end of each accounting period is called as deferred component of income tax expense. Final tax liability is the outcome of current tax liability and also deferred portion of the Income Tax Act. Now I give a table here. Three columns are there. First column, what is the base? The second column, deferred tax asset. Third column, deferred tax liability. First, you take temporary difference at the end of the year. What is the temporary differences you have to calculate? Multiplied by tax rate, current year's tax rate. Current tax rate will change every year. This gives the closing balance deferred tax asset. This is the closing balance of deferred tax liability. You take as per the balance sheet, it is given in the last year. Temporary difference at the end of the last year multiplied by last year's tax rate. It is the opening balance, you get it. So you deduct B from A. Deferred portion of the current year's income tax savings is the closing balance of the current year, opening balance of the current year. You get the row 3. What is the net effect here? If deferred tax asset is more than the deferred tax liability, then current year's income tax payable is less. If the deferred tax liability is more, deferred tax asset is less, then tax payable is more. You have to adjust the current tax liability against the deferred tax asset and deferred tax liabilities. I give you some examples also. Algebraically, we can give a formula for this deferred tax portion of the income tax expense or savings, which is equal to increase or decrease in the deferred tax liability plus increase or decrease in the deferred tax asset multiplied by tax rate. You get what is the deferred tax portion of the tax expense. Therefore, total income tax expense for the current year, which is equal to sum of current year tax liability plus deferred portion. It may be deferred tax asset or deferred tax liability, you have to plus or minus to the current year's tax liability. I give an example here. X Limited following information for the 2021. One is corporate tax rate is 25%. Pre-tax accounting income is 4 lakh rupees. Taxable income is 2 lakh rupees. Prepaid insurance premium, I have taken one example, prepaid insurance premium. This is a temporary difference, 20,000 rupees I have taken. Now you look into the two figures, first two figures. As per pre-tax accounting income, profit before tax is 4 lakh. Taxable income is 2 lakh rupees. One temporary difference is 20,000. If you calculate the out of these three figures, you find out the deferred tax asset or liability amount. First, you calculate the current year's tax. Current year's tax is equal to 25% of 2 lakh rupees. Taxable income is 2 lakh rupees. Tax rate is 25%. Therefore, you get 50,000 rupees current tax liability. Deferred tax asset at the end of this year, temporary differences multiplied by tax rate. Temporary difference is 20,000 rupees, prepaid insurance premium. Multiplied by 25%, you get 5,000 rupees deferred tax asset. Income tax payable, which is equal to current year portion 50,000, deferred portion 5,000, which is equal to 45,000 rupees. This is how we have to calculate the current year's income tax liability by taking into account the deferred portion of income tax. There are issues and solutions for this. I think this is a very complex issue in accounting because a blend of accounting and income tax, and for financial reporting we have to follow one rules, for accounting we have to follow another rules. That results in dual reporting system in our country. One set of rules for tax reporting, other set of for financial reporting. This dual reporting system results in deferred tax accounting. Suppose how to solve this? Your very simple solution is you go for a single reporting regime. What is single reporting regime? Suppose whatever the profit you determine the income tax accounting, pay the tax on that. Companies are not ready. There are companies which are giving dividend, which are making profit, but for income tax, they look like a poor man. They don't pay the tax. They take the advantages of the company income tax act and they reduce the tax. They follow the tax planning methods. They look poor for income tax authorities. They look rich for investors. Means they appreciate the presence of dual reporting system. They don't accept the single reporting system. So we cannot solve, we cannot eliminate the presence of deferred tax accounting. I come to the some of the India's income tax 12 is there. I can show you if you want. And I go to the tax reporting of Infosys Technologies. This is the income, the Infosys company's annual report. Are you seeing the annual report?
No, sir.
No, sir.
No, I can share it. I share it. 1 minute.
Okay.
Okay. Now you're seeing.
Yes, sir.
Yes, this is the annual report of current year's annual report of Infosys. I am going to show you the deferred tax accounting disclosure here. It is in page number 197. Can you see here? Income taxes, can you see? Accounting policy. This is the income taxes accounting policy information. I don't want to read here. If you read this, you get rich information. Income tax expense comprises current and deferred income tax. Income tax expense is recognized in net profit in the statement of profit and loss, except to the extent that it is related to the items recognized directly or in equity. This information is given here. Details of deferred income taxes, deferred tax assets are given. I show you here what I discussed in the slides. Income tax, current taxes of the Infosys company for 2021 is 6,013 crores this year. Last year it was 5,235. This is as per the Income Tax Act. The company has calculated the 5 heads of income. Deferred taxes last year, current year is 416. Bracket is liability. Last year it was liability was there. Deferred tax liability 301 crores. total income tax expense for the company is 6,429 crores. Means what I say is that for any company which determines the current tax liability on the basis of current taxes and deferred taxes. Income tax expenses for the year ended 31st March 2021 and 31st March 2020 includes reversal of 298 crores respectively. This reversal pertains to the prior periods primarily on account of adjudication of certain disputed matters in favor of the company upon filing of return across various jurisdictions. This is the information they have given here, how the company has calculated the taxable amount, 6,429. It has come here after adjusting the net taxable deductible expenses, deferred tax assets and deferred tax liabilities. And it also gives the information here, the income tax expenses, current income tax expenses. Okay. This is a company example which is making profit. It is making profit. I show you another company which is incurring losses. I'm going to the BSE, Bombay Stock Exchange. This is, are you seeing McNally Bharat Engineering Company Limited?
Yes, sir.
Yes, sir. Yes, sir.
This is a loss-making company. Because of pandemic, companies are incurring losses. I show you here one interesting audit observation relating to deferred tax asset and deferred tax liabilities. You look into this one, recognition of deferred tax asset. We draw attention to note number 7 to the statement that company had recognized deferred tax assets worth of 51,706 lakh up to 31st March 18, expecting adequate future taxable profits to the company against which the deferred tax assets can be realized, which is solely depend on accepting the debt provisions, debt restructuring provisions of the company. Means here, company has incurred losses continuously for so many quarters. It has recognized in the balance sheet around 5,517 crores. This deferred tax asset can be adjusted against only the deferred tax liability. When company is incurring losses, it won't pay the tax liability. This is an audit observation for a loss-making company by auditors. Why this deferred tax asset is shown in the balance sheet for a company which is not earning any profit. If there is no profit, company will not pay any tax. Okay, this is one example I have shown. Now I come back here, come back to my slide. This is Infosys company example I have shown you here. What we have seen in the annual report, current tax is for 5,235, 6,013. This is the amount we have seen in 194 page of the annual income tax annual report of the company. This is the explanations I have given here. I think we have discussed such explanations. This is my presentation. Now I am ready to take up some questions from you. What is my aim was to understand the provisions of income tax and provisions of Companies Act and how the deferred tax asset and liability will arise and what is the impact on balance sheet and also tax liability. You please ask questions.
Sir,
Yes.
I have a question, sir.
Yeah, please.
Regarding return down value method,
Okay.
I have seen some formula for that.
Okay.
Is it a thumb rule or a standard one?
No, my question is depreciation, how to calculate the depreciation. Suppose 10,000 is the cost of the asset, 100 rupees is the retail value. At the end of the life of the asset, you get 100 rupees.
Okay, sir.
I don't see, it's not a thumb rule, it's a scientific method.
Yeah,
If you
income
don't
tax.
take 1 minute. If you don't find 100 rupees residual value at the end of the year,
Okay, sir.
think your method is wrong.
Uh,
You
No,
follow
no,
SLM method or WD method.
sir, my doubt is income tax department gives certain rate structure every year,
Okay.
like 60% for computers,
Ah,
20% machinery.
100% also, yes.
What we have to accept, this formula or that's the
See, for income tax purpose, you have to follow income tax rates because income
okay,
tax
sir. Okay,
rates because of tax incentive. This is a tax incentive.
okay,
Whereas
got it, sir.
accounting, we have to follow accounting methods because return on value minus residual value divided by the life of the asset, it gives the depreciation amount for each year under WD method or straight line methods. But it is a tax incentive for companies. Why company gives 100% depreciation means for vehicles, for suppose a CEO of a company can change the vehicle 2 years, 3 years because
Okay.
if new vehicle give the depreciation so that he can get benefit. Yes.
Okay, sir, got it. Thanks.
Okay, next question, please.
Sir, one more question I have, sir.
Okay.
Sir, whether this temporary difference is to be considered while computing the book profit, sir? Book profit become
Book profit is entirely
150.
different. It is entirely different.
Right.
Section 115J, that is entirely different concept. Temporary differences purely arises because of difference in the amount charged to profit and loss account, amount deducted from the income tax purpose varies from year to year. As we have seen, depreciation amount on SLM method or straight line method, WD method. This is temporary differences arise only for tax purpose and accounting purpose. There are many temporary differences, outstanding incomes, prepaid expenses, because we follow accrual system in accounting and cash system of accounting. Income tax always follows cash system of accounting. Means expenses incurred, paid, only deducted. Expenses incurred but not paid, not considered Income Tax Act. Okay. Yes.
So which method of depreciation can be reduce the tax liability, sir? Either it is straight line method or WDV methods.
No method will depreciate. At the
No,
end,
sir,
initially, it is zero.
uh,
It is zero. Only you
yes,
get
sir.
benefit in the beginning year.
Yeah, beginning year we are pay. Yes.
So if you follow WDV method, in the initial years you get tax benefit.
Yes,
But
sir.
later years your benefit is offset. So if you look holistically for a 10 years asset period, holistically, sum is zero. If you follow this method or that method.
Okay, thank you, sir.
Sir, ITAC has prescribed only a WDU method, you know, sir?
Yes, definitely. Section 32 always says WDV method. Section 32. It won't recommend any other method.
Okay.
Only WDV method is recognized. That's why Income Tax Act says WDV method. Companies Act says that you may follow straight line method or WDV method or some of the S method. I think choice is given under the Companies Act. Choice is not given under the Income Tax Act.
So why, sir, the Companies Act can impose only the WDU method?
Right. Okay. This question should be asked to the tax authorities. Why? Because one answer is conservatism. Conservatism means if more amount of depreciation is given under the tax purpose, companies benefited in reducing the tax liability. Suppose WD method gives more depreciation, therefore assessees are happy. We are also assessees. Suppose income tax gives more deduction to find the taxable income. Are we not happy? We are happy.
But sir, in the initial period, we can claim more depreciation, but finally it
yes.
is going to upset, you know, sir.
Right. Definitely upset. Definitely. Certainly. But it is a sort of incentive, tax incentive for the assessees to encourage them to claim more depreciation in the beginning year so that the tax liability will be reduced.
Yeah, so in the initial period only, assessee is somewhat satisfied.
Yeah, definitely. We are assessees. If this year's tax liability is less, I will be happy. I think no, we don't think about the next 10 years. So we want to claim more deduction in this year and our tax liability should be less. This is nature of the individual. Means to pay tax, I think we are not happy to pay tax. Companies are also like that because companies are run by people. Yes. I can show you the Ind AS provisions.
Sir, it is not audible, sir.
Yeah, 1 minute. I'm missing. I'm trying to show you the provisions of the Income Tax Act.
Okay, sir.
Okay. The provisions of the screen sharing. ಸ್ವಲ್ಪ ಸ್ಕ್ರೀನ್ ಶೇರ್ ಮಾಡಿ HRDC. ಮ್ಯೂಟ್ ಮಾಡಿದ್ದಾರೆ HRDC. I want to show you the ಕಾಣಿಸ್ತಾ ಇದೆ ಈಗ ಇದು ಇಂಡಿಯಾಸ್ದು ಒಂದು ಚೂರು ಇದು ಸ್ಕ್ರೀನ್ ಇದು ಹೋಸ್ಟ್ ಮಾಡಿದ ಒಂಚೂರು ಕ್ಯಾನ್ಸಲ್ ಆಗ್ಬಿಡ್ತು ಒಂದು ಒಂದು ನಿಮಿಷ ಮಾಡಿ.
ಸರ್ ಮಾಡಿದ್ದೇನೆ ಸರ್.
ಮಾಡಿದ್ದೀರಾ? ಓಕೆ. Okay, are you seeing the Indian accounting standard? Are you seeing?
Yes, sir.
So just you look into this. Yes. Any questions you have? Okay, while preparing financial statements, we follow this Indian accounting standard 12. This gives you accounting for income taxes. This is for financial reporting purpose, not for tax purpose. tax purpose, we are following provisions of the Companies Act. This is for preparing financial statements. If you look into the objectives of Ind AS, Ind AS 12, you see here two aspects are given. The objective of the standard is to prescribe accounting treatment for income taxes. The principal issues in relating to accounting for income taxes, how to account for the current and future tax consequences if future recovery or settlement of the carrying amount of the taxes, assets or liabilities that are recognized in the current year's balance sheet, and also transactions, other events of the current period that are recognized in entities' financial statements. This is the objective is to find out the current year's tax recovery on the basis of future tax obligations or benefits arise from temporary differences. This standard gives you the basics. These are all the definitions. What is accounting profit? What is taxable profit? It defines the current tax is the amount of income taxes payable or recoverable in the respect of the taxable profit for the period. What is deferred tax liability defines are the amounts of income taxes payable in future periods in respect of taxable temporary differences. It also defines what is deferred tax asset, amounts of income taxes recoverable in future periods because of deductible temporary differences, carry forward of unusual tax losses, carry forward of unused tax credits. And it gives you what is the meaning of temporary difference. Temporary difference which are that will result in taxable amounts in determining taxable profit of the future periods when the carrying amount of the asset or liability is recovered or settled. I think we have given some examples of temporary taxable temporary differences and deductible temporary differences. This is arise because of prepaid expenses, outstanding incomes, etc. And this gives you the tax base to determine the current tax income and also to determine the deferred tax expense or deferred tax income. This is an example. I think just now I given you the examples here. A machine cost 100 rupees. For tax purpose, depreciation of 30 has already been deducted in the current and prior periods, and the remaining cost will be deductible in the future periods, either as depreciation or through a deduction disposal. Revenue generated by using the machine is taxable, and any gain or disposal of machine will be taxable, and any loss or disposal will be deductible for tax purpose. This tax base of the machine is 70. Means this is the depreciated value of the machine. You continue to provide depreciation under straight line method or WDV method, or you can dispose the machine if you gain profit or you incur losses, how you show the in purpose or tax purpose. Interest receivable has a carrying amount of 100. The related interest revenue will be taxed on a cash basis. Tax base of the interest receivable is nil. Like this, some examples are given here in the standard. And it also gives the recognition of current tax liabilities. And, current tax for current and prior period shall, to the extent paid, be recognized as a liability. If the amount already paid in respect of current or prior periods exceeds the amount due for these periods, the excess shall be recognized as an asset. Means the difference between these two amounts and the benefits relating to this recognition of deferred tax liabilities and deferred tax assets because of the taxable temporary differences. Okay. This is examples are given here. Just I run through this. I show you which are the requirements of Ind AS for determination of temporary differences. You know that goodwill arise under the business combination or mergers and acquisition of entities, two or more entities. How you treat the goodwill? You write off the goodwill amount in the profit and loss account as per accounting, and what the effect on tax purpose? I think you don't deduct the goodwill written off in the income tax purpose. We have these provisions, taxable temporary differences and deductible temporary differences under this standard. The requirements of this standard is followed by companies while preparing the financial statements. These are all the requirements. These are all more theoretical in nature. Suppose if you read the requirements of Ind AS, we have to read it along with the annual report of a company. You take the annual report. Just we have seen the Infosys annual report. Try to read the contents of the standard and content of the annual report, and you try to understand how the company has followed the requirements of Ind AS while preparing the financial statements of the company. Okay. These are